Good morning and welcome to the Killik podcast for Friday the 14th of August. This week's been all about the Chinese devaluation of their currency, and it's logical because we've been talking about the slowdown in that economy, and they've been pegged to the US dollar, which has meant that they haven't been able to stimulate their economy by lowering their currency and increasing their exports. So this week they pulled down that peg, or the range within that peg can operate, and we saw quite a sharp fall in the currency. So here it is, it's a 4% fall over the week, and it's rattled markets to a certain extent. So we saw quite bad days for European and US markets, particularly the European market, which has a higher trade-weighted exposure at 17% to the Chinese currency against the US, which is around 14%. And it particularly affected the areas of the market that sell into China. So we've had weakness in commodities, technology, luxury goods, autos, capital goods in the main. So where do we go from here? Well, the market is looking at a 10% devaluation as a base level. And I think if you look at the European markets in aggregate, that could impact earnings in about 5% across the board. So it's something that we need to be aware of. Looking at individual companies, here we've got a list of the stocks, certainly the Killik stocks, that are most exposed to the Chinese economy in terms of their percentage of their 2015 revenues. And as you'd expect, you've got the commodity stocks up at the top, BHP, Glencore, Rio Tinto, Prudential, 24% of their revenues coming from China, Apple, 23%, then some of the luxury goods companies, so Richemont, 26%, and the autos, BMW 18, Volkswagen 14, Intercontinental Hotels Group at 15, and Nike at 9. So the impact for these businesses is firstly through the translation effect. So the earnings that they make in RMB are going to be worth less because the currency is depreciated. But there's also a secondary transactional impact where they're going to be slightly less competitive than the Chinese manufacturers, and therefore may lose some market share. So that aspect of it is slightly harder to calculate. A lot of it is, however, offset by the movement of manufacturing to China. So the costs associated with these revenues has also gone down with the devaluation. Whilst driving markets in terms of the overall pattern for markets, it's also very important in terms of Fed policy and interest rate policy because the trade-weighted dollar has appreciated as a result of that Chinese devaluation. And again, that's pushing back potentially the timing of that interest rate rise in the US. And you know, we still feel that interest rate rise and the path for rates in the US is the most important thing affecting markets in the second half of this year. So, you know, to a certain extent, we've been trying to hedge that through the banks, and we saw some weakness in the US banks, which was surprising given the news. But the second round effects of potentially interest rates going up slower and not going up in September has affected the banks because that's the story. Higher interest rates help their net interest margins, despite the fact they haven't got any exposure to Chinese revenues. So we've also seen further retracement of oil and commodities back towards their lows that we saw in early part of this year. That's also dragged down the renewables because their relative value is set against the cost of energy in terms of oil. So we've revisited the renewable story. We think it's a really interesting long-term structural growth story. And this is all predicated on the fact that we think in due course the people will move from a centralized grid system to a localized power system because it's cheaper and it's more reliable. You've got more control over it. You're not subsidizing old legacy ways of generating power that are less efficient and environmentally expensive. So within renewables, we favor solar. And within solar, we favour the US market because the penetration there is far lower than Europe, and we think it's got a long runway for growth, and the conditions for solar are better than Europe. So that doesn't really stack up. And specifically, we like Solar City, which has seen some very strong growth that we saw in their numbers a couple of weeks ago, with residential installations up 100% year on year, and those costs of installing those installations coming down 9%. So they now have around 40%, or at the start of the year had around 40% market share in the US. So we do feel the risk return or reward for the developers and the asset owners is far better, and we want to own companies that have got scale. They've got great development skills and project skills. They've got a low weighted cost of capital, and we think ultimately they could also be takeout targets. So I think it's a good opportunity with Solar City back at that sort of low point. In terms of the week ahead, quite quiet for Killik & Co stocks, with Glencore the only covered name coming through. Some interesting results coming from the house builders, so Bovis on Monday, Persimmon on Tuesday. Quite a lot of retail in the US, so Home Depot, Walmart on Tuesday there, Target, Lowe's, L Brands on Wednesday in the US, and some few more mining pieces of results, and that's a bit. And then John Deere will be an interesting one on Friday. So looking at Glencore in a little more detail, the share price has been under pressure following their production data that we had a few weeks ago ahead of their results next week. This is obviously due to weakness in commodity prices, but the worries about Glencore are based around the fact that they have a portfolio of mines, and therefore their cost of production is higher than the likes of Rio's or BHP Billiton, and therefore their margins are lower. We've also had a little bit of nervousness about Noble results, so they're a big commodity trading division, and clearly there's a read across to Glencore's business there. And finally, the business has a relatively high or geared balance sheet, so net debt to EBITDA is around 4.7 times. So what we want to see in these results is the group cutting capex and using other operational measures to start to increase that cover and safeguard their credit rating, rather than having to come to the equity market and have a rights issue as we've seen at some points in the commodity cycle. So that's it from me. Thanks for listening. Have a good weekend.